is if you have a policy with a $100,000 MEC limit, let's assume that, and you are paying, let's say your premium slash PUA payment is $100,000. So you fund right up to the MEC limit. But then you've got a 1035 exchange coming over. Let's say it's a big one for $200,000. That 1035 exchange can exceed the MEC limit, or another way to put it, like Nash had stated in his comment, is it does not count against the MEC limit in any way, shape, or form. So basically what would happen that year, in the first year, is your payment of $100K plus the $200,000 input from the 1035 exchange gives you a $300,000 input in the first year, and you would not MEC out, which is a nice feature. You can really stuff the cash value nicely in cases like that with a 1035 exchange. Now, to add a bit more information to 1035 exchanges, I do like to look at what the policy looks like, the existing policy they have, if they continue on their path, or if they enhance that policy, meaning don't look at a 1035 exchange and then compare that to a 1035. I like to look at the guaranteed and non-guaranteed values and really put myself in that same position, because there's a lot of cases where 1035 exchanges do not make sense. Sometimes they do, depending on the original design of the policy. Maybe it's not that flexible from a PUA limitation standpoint, whatever it might be. But often where people make mistakes, when I say people, agents make mistakes with 1035 exchanges, is they'll look at the illustration comparing the non-guaranteed values and say, hey, the new policy looks so much better, let's roll it over. And the policy under-delivers, things go wrong, and we kind of find out after the fact where we've already rolled the money over. So just always acting in the best interest of the client, it is good to compare things side by side. And that can be somewhat complex. We're going to add content to ILS on 1035 exchanges, how to approach them appropriately. You can always email us if you have questions or a specific case. We can definitely take a look, as that will always be valuable. I know I always add extra info. So what we're going to look at here is as follows: how to present the following to a client. We're going to assume we've got an age 55 male. It's with an actual case, actually, that he's interested in whole life insurance, specifically for the cash value. That's his point of interest. He's got a number of businesses, has an idea of what he wants, but he's not certain how much he'd like to pay in. So during the meeting, it was me and another agent. The question that I asked him was, hey, from your research thus far, we discussed how to design a policy for maximum cash value. My question was, is there a certain amount from your research thus far that you'd like to be able to pay into the policy each year, Mr. Client? Didn't really have an answer. I'm like, that's okay. Is there an amount that you'd like to have the ability to pay into a policy on any given year? Another way to put it, Mr. Client, is if things go very, very well, perfect world scenario, how much would you like to be able to get into the policy? And you get a little bit of silence, so ask another follow-up question. This way the client never feels awkward and never want him or her to feel awkward. Ask, that can be a range as well. We won't hold you to it. Just really gives us a good starting point. He says, okay, from everything thus far and my cash flow, I might want to pay anywhere between $100,000 to $250,000 per year. So that's a big range, right? From a cash value life insurance policy. And if we take a zero off of each and make it $10,000 to $25,000 per year, that is still a very big range, because the performance can be drastically impacted depending on what policy design you select and how you actually fund it. So what he wants to see, where he's at presently, is anywhere between $100,000 to $250,000 per year. I understand the core benefits of the product, meaning when I look at the cash value, he understands the following: that it is a safe, liquid, I always like to go over these points. Tax-free area to position money. If you have a prospect or client who is very technical, if you ask them what they do for a living or you get the sense that they're an engineer, an IT professional, this individual has a background in HR, so it's going to be very technical, wants the detailed bullet points, don't just give them vague salesy answers. So you got to know your buyer in that respect. So what I did first was go over this with the client, core benefits to the cash value, safe, liquid, tax-free. Got the sense he wanted a little bit more. So to elaborate, Mr. Client, safe in the sense that if things are going very, very well in the stock market and economy, or if things are going very, very poorly in the stock market and economy, you can expect these policies. The illustrations are going to show different numbers, but you can expect a well-designed policy with one of the major mutual carriers to deliver somewhere between a 3 to 5% net internal rate of return. And that'll be consistent as the years pass. Liquid, you can access your money anytime you want. Typically, right after starting a policy, the insurance company may want you to wait 10 business days before requesting a loan. They just want to make sure that the funds clear the bank account, that kind of stuff. But aside from that, you can access your cash value anytime that you'd like. And then tax-free if we do so properly, if we don't trigger a taxable event. One example is the modified endowment contract. And him and I, we had already gone over the MEC limit. So I do like to reiterate that. So the core benefits of the cash value, that's what he's interested in. How much does he want to pay into the policy? Well, again, we've got this range between $100,000 and $250,000 per year. The next point I like to hit on here is when someone says that between $100,000 and $250,000, here's exactly how I would reply. Thank you for that info. So in a case like that, Mr. Client, if we take the high end number there, you know what? Let's start with the low end number, the $100K per year. How we would design a policy if you, Mr. Client, said $100K per year is the maximum amount of money I want to get into the policy on any given year. How we would design that policy is as follows, based on the limits available by the insurance carrier. Oopsie daisy, there we go. We would design it for maximum cash value. So your money can go toward one of two areas, the premium piece or the paid up additions rider. We'd set the premium at $10,000. That would be your annual commitment. It'd be a little bit more than that because we'd have term insurance attached as well. A term rider can go through that in full detail with you. But this would be about your minimum premium. And then you'll have the ability, not requirement, but ability to add another $90,000 per year into the policy, add those two together, you have a total of $100K. So now you've got a policy where you can go up to $100K, but you're only committed to $10,000 or the minimum premium. So now you've got a flexible savings asset where you can just stuff the cash value at your discretion. Any questions on that, Mr. Prospect? Does that make sense? What I would do, especially if you're new, when we're a new agent or when we're new in any profession, we have a tendency to get very excited and we get what is called motor mouth. I know I have that sometimes. I feel like I had it recently because I was sick for a little bit and I wasn't on the phone as much as I usually am. So then sometimes I have a tendency to talk really fast, go from one point to the other. It's like, Steve, breathe, you got to slow down. So I mentioned that to say, if you're new or if you have a tendency to get excited and talk too much, because that can be a turnoff to clients, what I like to do is always interject in the conversation, things like this. Any questions on that? Does that make sense? Or sometimes I'll ask it in a different way. Does that make sense? 1 second, come on. There we go. Does that make sense? Sometimes I'll ask that by, instead of saying does, I'll state, if that makes sense. So I'll explain something and then say, so the premium is 10,000 and you can add up to 90,000 per year for a total of 100 grand per year. If that makes sense. Any questions on that? And again, if you're new, you may want to jot these questions down. And what I would try and do is just when you look at human nature, 3 to 5 minutes, and I would even do it more frequently than that, it can be every 1 to 2 minutes, just add something in there. Any questions at that point? Does that make sense? This way, one, you always give them the opportunity to interject, keeps them engaged. That way, mentally, they don't fall asleep. But then two, if they do have any questions, by you frequently asking, they can ask you, and then you can hit on a point instead of making a false assumption that they understood it. The little things like this, as you're just progressing through your presentation or through your conversation, the checkpoints to confirm that they understand things. This will help them remember as well. This really helps the process when you actually get to the numbers, they get it. And if anyone has questions as we go through this, feel free to chime in or type in the chat box. So back to this, he said anywhere between $100,000 and $250,000 per year. So Mr. Client, thanks for that info. That's a great starting point. The reason why I asked that question, how much do you want the ability to pay in, is if it was $100,000, what that means is we would design it where you have a $10,000 minimum and the ability to go up to $100,000 per year. If we set $100,000 at the max, though, that is the maximum you can pay in during any given year. If we picked $250,000, very similar to the 100K example, we would design it in a manner where you have a minimum premium of, guess what? 10%, which would be $25,000. I like to ask the question, and as I'm writing, pause maybe for 2 or 3 seconds, giving them the opportunity to answer, but I'm not going to sit there and make them answer because some people feel awkward with that kind of stuff. Some people are turned off, they won't tell you, but if you try and force them to answer with those tactics, they don't always like it. So I like to keep it open for them, but if we don't get an answer, I'll answer it for them. Because mentally, I want to make things as easy for the client to understand as possible, and also as convenient as possible for the client. Make life easy for them, make them very, very comfortable. That's so important. So they can add another $225 per year. And then one other thing I'll add here as well for the client to see is, Mr. Client, if you do select the high-end option, for example, the $250 per year, one of the things that we have found has been very, very valuable for people to see up front is, one, what does it look like if you max fund a policy at the $250,000 per year, just like we see here? But what does that same policy look like if you say, hey, I want the policy with a 25K minimum, the ability to go up to 250? But what happens if you go with that option and the max you ever pay in, say 100,000? So I took out a policy where I could pay up to 250 per year, but I bit off more than I can chew. I overcommitted. How much will that cost me, or how much will it hurt me in terms of cash value performance? Mentioning that, and I would practice explaining it first so you can progress through everything, but mentioning that to clients and then showing that in some examples, especially larger cases, goes such a long way. Because what you're doing is immediately showing them a weakness where the product does not always shine. Where traditionally, people in the financial services space and insurance agents are only going to show the good, only show the good. They don't want to talk about anything bad out of fear of losing the sale. And where people are going to have regret, where they're going to get frustrated, is when they find out about the bad stuff after the fact. Which it doesn't matter what product it is that you're selling, there's pros and cons, no matter what it is out there. So a drawback to cash value life insurance is in the early years. If I have a policy where I can 10x the base premium, max fund it, but I don't max fund it, the policy won't perform at the same level. Just awareness, knowledge that you have being in the business, helping your consumer take in that knowledge as well, or providing the awareness so they know that you're looking out for them, that'll go such a long way for you. It builds that trust factor as well. Think of it, if you're working with someone, you want to be able to trust them. And if they're showing you the drawbacks as well, they're not beating up their own product, but they're saying, hey, here's where a lot of people like it, but here's where people have gone south sometimes, or you've seen them say, I'm going to put all this money in, and they never come close. That's where we can see the policy underperform quite a bit. And it's like, thanks for telling me that. Maybe I'll go a little bit more conservative, or no, I'm good going aggressive because I know I can hit it a couple of years, but it's the awareness factor, and you prevent so many headaches and issues occurring down the road after the sale. We don't want to be so focused just on the sale. Remember, this is a long-term play with your clients. So what I'm going to show next is the Excel spreadsheet and a couple of detailed illustrations that we went through with them. So here we go, Mr. Client. Get this up here. There we go. So on the Excel spreadsheet, Mr. Client, we have 3 tabs you'll notice on the bottom left-hand corner. You'll see 100K, 150K, and 250K. What these represent are funding scenarios of max funded policies, 100K for 5 years, 150, and then 250 for 5 years. Why I ran 5 years is that takes you up until about age 60. In reality, we can fund for a shorter period of time, longer period of time. This is mainly just a starting point. Another thing I want to mention, Mr. Client, is when I say max funded policies, what that represents is if you've got $100,000 going in, where can the money go? Toward the premium, toward the PUA piece. We've got the premium at the absolute minimum, right at that 10% threshold, and the ability to go up to 100K per year. So again, all of these represent max funded policies. We're not showing any of the samples here of what a policy looks like if we underfund it. So when I can pay up to 250, but I only pay in 100, going back to that example, we don't have that on this sheet. However, it's something we can definitely show as we start to narrow things down. But that's what this represents. Give my pen a second to kick back to life. There we go. So question come through. Good side question, actually, from Elijah. For Guardian Index, do you need your securities license to sell it to clients? No, you do not, which is nice. Just an insurance license with any indexed product. Indexed annuities, IULs are true as well. We don't sell them. But to answer your question, you do not need a securities license. So here we go. On the spreadsheet here, what I put together, Mr. Client, are just 3 samples. You'll see 2 options with Guardian, and then 1 option with Mass Mutual. What I will add first and foremost is the Guardian option. You'll see L95 dividend, and then the L95 index. These are actually the exact same product. So you don't have to choose one or the other, which is nice. I did include an additional video, or I'll send you a video that explains exactly how that indexed feature works. To provide a brief summary, it's a rider that can be attached to a whole life insurance policy, excuse me, that grants a little bit greater earning potential on your cash value. Now, the nice thing is you can actually switch back and forth between the dividend option and the indexed option as the years pass. You can even elect to tie 50% of your cash value to the dividend, 50% to the index strategy, and you can adjust it each year. But again, we can talk through that more, but Mr. Client, I did include a video. So to break away for a little bit, what I will encourage everyone subscribe to ILS to do is any videos on our YouTube channel, our indexed rider, for example, or indexed rider video, you can use that. And what I would do if you ever share it with the client is let them know that you do work with us. That typically prevents a client from reaching out to us. You can even take an additional step if you send any of our content to educate clients. Just let them know that you work with us, or you can let us know as well, saying, hey, I shared this with someone I'm working with. This way we have a heads up, and if they come through our system, we don't work them because we want to do that to anyone that is subscribed to ILS. But I know some people have just said, hey, this is a company we work with. Here's a video that provides just a quick overview. And people like it because it's a video they can watch. So with Guardian, we've got the same product here, just demonstrating the indexed rider and then the basic dividend. And then we have a Mass Mutual product here, whole life 15 pay, which means you can pay into it for a maximum of 15 years, but you're not required to. So as we look at these guys, this is based on a 55-year-old male. We see $100K per year paid into the policy for 5 years. What is highlighted in yellow represents the break-even point. What you will find is all three of these options are right around a year 5 break-even, which with the new 7702 change for a 55-year-old male is fairly common. A high early cash value product might get you a year earlier. It's typically between years 4 and 5, but it's typically going to fall in a case like this between years 4 to 6, right around year 5, like we see in this example, as these are minimum premium, maximum cash value products. So we see the break even right around year 5 in all of them. And before we progress on to the other examples, and I want to go through the illustrations as well, what I'll add here, or what I do want to interject with, is some of the differences in flexibility. Because often one looks at these projections and say, okay, if I were to look at the year 20 cash value, with the Mass Mutual option, I've got 957, and indexed is hypothetical, right? Because it's based on the S&P 500 history. Who knows what's going to happen there? If I look at the Guardian dividend option, it's 954. Like, well, what's the difference? Who cares? There's not much of a difference. What I'll always state to clients is, or prospects for that matter, right, before their clients, is Mr. or Mrs. Prospect, these projections will show different values, and you'll see different companies project greater long-term values than each other and such. Here's what I'll add, or here's what I'll state. If you have a whole life insurance policy that is designed with a minimum premium and maximum cash value, and it's with one of the major mutual companies, what we have seen to be so consistent based on the actual data that we have is they all go back and forth with each other. Even though one company may project greater values at one point in time, you could literally close your eyes and pick one of them out of a hat, and you cannot go wrong by any means. I always like to state that. Excuse me. Swig some water here. So actual performance almost always works out in the wash over time. The other thing I want to touch on, though, Mr. and Mrs. Prospect, is really the factor that helps an individual refine his or her decision-making process. So we've got a number of options here with two of the 4 major mutual companies, Mass Mutual or Guardian. Which one's better, or which one should I choose? Because they will ask you that. That's going to happen. So how I'll often answer this question is, again, Mass and Guardian, same thing with New York Life or Northwestern Mutual. You can close your eyes and pick one of them out of a hat, and you cannot go wrong with any of them. Based on the historical performance we have, when you look at banks, corporations, they use all 4 of those carriers, and they've delivered. What often refines an individual's decision-making process is this guy, flexibility. So often what people do not like about whole life insurance is what? It's got the word insurance in it. We think bill, I have to keep on making a payment. We went through the policy flexibility, but still, remember, people are educated for years that insurance equals bill. Now we're showing them how to use it as a flexible savings asset. When we say it 1, 2, or even 10 times, don't expect it to stick, right? Think of it, if you've been used to doing things for a certain way, and I just say, hey, things are different now. You can do things, you've got a flexible policy. We're all creatures of habit. Like, it's going to take some time. So flexibility helps individuals refine their decision-making process with company selection. So looking at Mass Mutual and Guardian, to provide a brief recap or just overview on flexibility, here we go. Both companies can carry a design where you can have a 10-90 split, meaning a 10% premium, 90% toward PUAs. So if you want 100,000 to go in, you can have a premium of 10K with both. Guardian, you can actually go a little bit lower. Then everything else can go into PUAs, minus the term rider. Here's the key difference. With Mass Mutual, they will allow for contribution adjustments or payment adjustments one time per year, every year, provided that the payment adjustment fall on their policy anniversary date. Now, what I'll add to everyone on this call is the term policy anniversary date. We know what it means because we're in the business. That has confused people sometimes, that terminology. So again, it's a little thing, but we don't want to assume people know what that means. So what I like to do here, so if I rewind, Mass Mutual will allow for payment adjustments to occur one time per year, every year, provided the adjustment fall on the policy anniversary date. So for example, Mr. Client, if you started a policy today, January 5th, then January 5th of each year is your policy anniversary date when your premium is due. So what Mass Mutual allows is year one, let's assume that you pay in 100K, you max fund it. Year two, things are a bit slower and you only pay in 50K. That means you could have paid in another 50,000, but you did not. And the thing with Mass Mutual, if you said, hey, I want to throw in the other $50,000 6 months later, so let's assume that your policy date is in January, you want to throw the extra 50K into the policy in June. Mass Mutual will typically require some type of medical underwriting for you just to throw money in on a random basis. Now, if you set the policy up with their planned AILR, you could work around that, but you've got that 2-year window. It's not that flexible. It often confuses people. We can touch on that in another call, but that is one way you build in some flexibility to avoid the underwriting, but it doesn't work for most people from experience. But going back to this, if you want to add the additional 50 at random, hey, I've got the money now, can I throw it in? Mass Mutual may and often does require some type of medical underwriting before they accept the money, which is a pain. No one wants to do that. So what we have to do is wait until year 3. At that point, we could pay in 100K. You could even pay in 150 if you wanted to make up for lost time. But one time per year on the anniversary date is when we can actually make the payment adjustment and then throw the funds in. Now, again, to provide additional info, because if you're working with a technical buyer, they're going to think this, hey, I've got 1 day out of 365 days per year to make that adjustment. It does not have to be on the exact day, Mr. Client. You actually have a 60-day window, which you can make the adjustment. Mass Mutual will give us 30 days before through 30 days after to adjust the payment, and then we can send the dollar amount in that we'd like. So where Mass Mutual works very well is if I'm comfortable and disciplined enough to make a one-time per year payment adjustment. That's where Mass Mutual comes in with their flexibility. Their sweet spot, in my opinion, is if someone wants a minimum premium policy, say a 10-90 split, they want the ability to pay into it for a long period of time. So they might say, hey, I like the option where I pay into it for 5 years, but if things go well, I might want to keep on feeding this thing and pay into it for 30 years. Can I do that? And the answer is yes with Mass Mutual. So if I'm comfortable and disciplined for that one-time per year payment adjustment, but I want strong cash values up front, a minimum premium, and I want to feed this puppy for a long period of time, I can do that with MassMutual. That is their sweet spot. I can keep on feeding the product, depending on the product choice, of course. Usually a higher early cash value L65 or L100 will allow that. Guardian, on the other hand, is a company where I could go at that same 1090 split, but here's their advantage. I can easily commit to the minimum premium only, call it 10,000 in this case. In reality, it might be 11 to 12K when I attach the term rider, but my point is I can commit to the minimum only. I can pay that on my anniversary date when my premium is due. I could even decide to pay it 10K one time per year, or I could break it up over 12 months, which is nice. But I can commit to the minimum and then 100% at my leisure, I can just throw money into PUAs. And how I do that specifically, so I can go on my computer, punch the dollar amount I'd like to add in the PUAs, sync my bank account up with that. Through a mobile app, I can send in a check however I'd like. So they're extremely convenient in that respect. Now, that's their advantage and their flexibility, so I can commit to the minimum at any time I'd like. Their sweet spot, in my opinion, when you really look to maximize the internal rate of return on a life insurance policy. So if a consumer says, hey, why I'm doing this is maximum cash value, I want to speak directly to that every single time. Guardian's sweet spot is if someone said, hey, I like this policy and I love the idea of max funding this thing for 10 years or less. Maybe their goal is 5 years or less, 7 years, whatever it might be, where you will maximize the internal rate of return on a Guardian product is if you are funding it for 10 years or less. So for example, it could be 100K per year for 10 years. And then from year 11 onward, I either pay 0 or it's a reduced amount. I won't be able to pay the 100K per year in anymore, but maybe it's just a base of 10K, maybe it's 20K, a reduced amount like that, where it's significantly less than the 100K. But in order to maximize the policy, if you said, hey, I'm comfortable or I really intend to max fund it for 10 years or less and then stop, or maybe pay just the premium or something like that, Guardian will work very well. But what I'm trying to do is just sprinkle in the main bullet points so people know, oh, okay, I'm interested in that. Or when I say 10 years or less, they'll say, like I want to be able to pay in longer. And they're going to start to gravitate toward MassMutual. Or maybe they like the flexibility. But adding those talking points there as you have that conversation, people do appreciate that. Remember, they want to know what you know being in the business so they don't find out about something after the fact, because that's where the pain point comes in, especially in this industry. The more pain you can alleviate, the better off you are. All right. So we've got everything side by side here. We've got the flexibility features where we went through that. And this really just shows side-by-side comparison. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.